Hello and welcome back to Bhavani JIIB. Today we are talking about retail banking specially made for Indian bank employees aiming to crack JIIB. In our journey through paper 4 module B, we start with the 15th unit, securitization of assets. Here we will be learning about the securitization of assets, securitization process, the advantages, RBI guidelines, MHP and MRR, securitization of NPAs. So, what is securitization of assets? Let's say a bank gives out home loans, car loans, and credit card limits. These loans bring monthly payments from customers. Instead of waiting years to collect that money, the bank can sell these future payments to investors. This process is called securitization. The bank collects similar loans, puts them in a bundle, and sells them to an SPV, that is a special purpose vehicle, which then sells it forward to investors. This way, the bank gets cash now and the investor earns from the future payments. Here, we have some important terms that we need to learn. Obliger is the person who owes the money, and originator is a bank or lender that creates and sells the loan. Securitization is converting these loans into securities. SPV is a special purpose vehicle that is a separate legal entity which converts these loans into securities. Sponsor is the one who sets up or promotes this SPV. So this is about securitization of assets. Okay, so you need to understand that the bank collects similar loans, puts them into one bundle, okay, and sells them to a SPV, which then sells it forward to the investors. So we will learn more about the securitization process in the next slide. See, the process of securitization, what happens is the banks or the financial institutions will collect money into a pool and then they divide this pool into small parts and sell them as securities. The buyers of these securities get interest or mortgage of these payments, and these securities are called mortgage backed securities. If we have to divide the process of securitization, we can divide it into two steps. The first step is pooling and selling, as I had already told you here. So, banks select similar loans, for example, all home loans or all personal loans, and sells them to a SPV, a separate legal entity. It gets immediate money. Okay. Step two is issuing these securities. SPV sells these bonds as certificates to the investors. So these investors receive regular income from the loan repayments. So this is about the securitization process. Then why should we do it? I mean, what are the advantages of securitization? It frees up the capital for banks by moving loans off their balance sheet. So when they are pooling these loans and selling it to another SPVs, which are converting them into securities, you are freeing up the capital from the banks because these loans will be moved off the balance sheet. They'll be moved away from the balance sheet. Transfers risk from banks to investors. So basically, you're transferring the risk of whether the person who has took the loan pays or not. But this risk has been shifted from banks to the investors. It improves liquidity. So banks get immediate cash, like I had already mentioned. Banks get immediate cash from these SPVs. Lower funding cost. Due to reduced credit risk, there will be lower funding costs under this method. Better asset liability matching. It supports long term lending for the banks. because bank will have more cash that way. And also there are few more like converting non-liquid loans into liquid sellable securities. Okay, so these are the advantages of securitization of assets. Next, we look at the RBI directives, that is the RBI guidelines, as in to keep this securitization safe and simple. Okay, so see, RBI has issued new guidelines in 2021 and it applies to all scheduled commercial banks except for RRBs. And it is also applied to the NBFCs, that is a non banking financial companies, the small finance banks. Okay. And here we need to look into two things here. That one is the minimum retention requirement, that is MRR, and minimum ticket size. So here, minimum retention requirement for loans which are less or equal to 24 months will get 5%. Loans which are more than 24 months or bullet loans. Bullet loans in the sense that you will have to pay the interest and the principal together. So that will get 10%. And residential mortgages like our housing loans will get 5%. So this is about the MRR and the MHPs. But let's learn more in depth about this MRR and MHPs. So you have to just understand that minimum ticket size of securitization note should be 1 crore. So when you are making a securitization, that is grouping a loan and selling it as securities, the minimum ticket size should be 1 crore. So this you have to remember. Okay. So what is MHP? That is the minimum holding period. See, the originator bank or the NBFC must hold the loan for a minimum period before securitizing. So, before you convert it into a security, you have to hold it for a minimum period. Okay. What is the purpose of holding it like that? It ensures project risk is not transferred early and it ensures repayment history is seen. So, only when the repayment is correct is when you can convert it into a security. And even the project risk is not transferred very early. So risky loans are not transferred is what they're trying to say. Okay. The next is minimum retention requirement. That is MRR. Originator must keep a part of the loan risk with itself. So which means you cannot transfer the complete loan risk to the investor. Okay. So you have to keep a part of that loan risk with you. So what they're trying to say is even after selling loans, bank must keep some share. This ensures the bank stays careful and involved. Okay. So that was the percentage that we were talking in the previous slide, that the MRR, that is the minimum retention requirement, is 5% for less than 24 months of loan, and more than 24 months of loan should have 10% of MRR. Okay, and residential mortgages will have 5%. It's because the percentage is less because there is a mortgage of that property. Okay. So here we are coming back to MRR. What is the purpose of this? To make sure that the bank has a continued interest and promotes proper loan screening and monitoring. So if you know that a part of the risk lies with you, you will definitely do proper screening and monitoring before giving the loan. So that is about MHP and MRR. You have to remember these two topics. Next is the securitization of NPAs. That is bad loans. We are talking about bad loans. When customers don't repay, the loan becomes a NPA. Okay. So banks can sell these NPAs to other companies like the asset reconstruction companies, that is the ERCs. Okay, bad loans. to recover the money. This is called securitization of stressed assets. So this we have already spoken in the previous chapter. We have the SURFACE which talks exactly about this. So banks can sell stressed or the non-performing assets that is to clean their balance sheets. So these assets are sold to asset reconstruction companies or investors, and this is different from normal securitization because these loans are already in default and risk is very high. So already the risk is very high because the loan is a non-performing asset. It's the person is not paying, right? It's a defaulted loan. So selling these to the asset reconstruction company or the investors is called as a securitization of NPA. So this already we have spoken in the previous chapters in SURFACE. Okay. So for us to remember this securitization topic, we need to know that securitization is like turning loans into products that can be sold. It helps banks get quick money, it spreads the risk and makes the financial system stronger. So this is the whole purpose of securitization of assets. So far we have learned about the securitization of assets, the process of securitization, the advantages, what are the RBI guidelines for securitization, the MHPs and MRR, and the securitization of NPS. Don't forget to subscribe for more insights into the world of banking. Stay tuned, stay informed, and keep banking the Bhavani JAIIB way. Thank you. And next up, we will be learning the next unit, the module C, support services. Until next time, happy banking.